What if the financial system you were told to trust your entire adult life quietly disappears before you even finish paying it off? For decades, the 30-year mortgage has been more than just a loan. It has been a symbol of stability, a predictable path toward ownership, and a cornerstone of the middle-class dream. Parents pass it down as advice. Banks package it as security, and entire neighborhoods were built around its rhythm of monthly payments stretching across 3 full decades. But as we approach 2040, the question becomes impossible to ignore. Is the 30-year mortgage coming to an end? And if it does, what happens to the future of housing finance? The truth is that nothing in the financial world remains permanent. Systems evolve, markets adapt, opportunities shift, and those who prepare for change before it becomes obvious are the ones who position themselves ahead of the curve. The foundation of homeownership has always relied on affordability, predictability, and trust in long-term economic stability. Yet today, rising interest rates are reshaping borrowing costs in ways that make a 30-year commitment feel heavier than ever. What used to be a manageable monthly payment can now feel like a long-term financial anchor, tying individuals to decades of obligation in an increasingly unpredictable economy. The numbers are no longer just numbers. They represent lifestyle choices, career flexibility, and personal freedom. When borrowing becomes expensive, people hesitate. When people hesitate, demand shifts. And when demand shifts, entire financial models must adjust to survive. Technology is also accelerating transformation at a pace few anticipated. Artificial intelligence is redefining how lenders evaluate risk, approve borrowers, and structure financing options. Automated underwriting systems analyze thousands of data points in seconds, removing human bias while simultaneously tightening qualification standards. This means that the future borrower may not be evaluated solely on traditional metrics like credit scores and debt-to-income ratios, but on dynamic behavioral data and predictive analytics. The mortgage of tomorrow could look radically different from a mortgage of yesterday. At the same time, new ownership models are emerging. Fractional homeownership, real estate tokenization, and shared equity programs are gradually introducing flexibility into a system once defined by rigidity. Instead of committing to a single property for 30 years, future buyers may choose hybrid models that allow partial ownership, shorter financing cycles, or adaptable payment structures that evolve with income growth. These innovations are not science fiction. They're early signals of a broader shift in how society views property. Ownership is no longer only about permanence. It is about strategy. Graham Stephan says that the housing market constantly evolves with economic conditions, and those who understand these shifts early are the ones who benefit the most. That statement carries weight because history consistently proves it true. The housing cycles of the past rewarded those who anticipated interest rate movements, demographic trends, and lending changes before the mainstream recognized them. As affordability pressures increase and automation becomes more sophisticated, the definition of a standard mortgage may begin to blur. Stricter lending standards could make qualification more challenging, particularly for buyers over the age of 25 who carry student debt, fluctuating income streams, or non-traditional employment patterns. Meanwhile, automation may reduce costs for lenders, potentially introducing new products that compete directly with the traditional 30-year fixed model. The real question is not whether change will happen, but how fast it will happen and whether you will adapt in time. The future of housing finance will likely be shaped by 3 powerful forces: economic pressure, technological innovation, and behavioral evolution. Economic pressure pushes institutions to rethink long-term fixed-rate commitments when inflation and rate volatility create uncertainty. Technological innovation allows lenders to design smarter, more personalized financial tools. Behavioral evolution reflects how younger generations prioritize flexibility over permanence, mobility over settlement, and access over ownership. When these forces converge, they create disruption, and disruption always produces both risk and opportunity. The individuals who view uncertainty as a threat may hesitate and fall behind, but those who treat it as an invitation to learn, analyze, and prepare will discover new advantages. The 30-year mortgage may not vanish overnight, but its dominance could gradually weaken as alternatives gain credibility and acceptance. Understanding this possibility is not about fear. It is about awareness. Awareness creates preparation. Preparation builds confidence, and confidence transforms uncertainty into leverage. As we explore the possibility that the traditional mortgage structure may evolve by 2040, it becomes clear that the conversation is larger than interest rates or loan terms. It is about financial literacy, adaptability, and long-term vision. It is about recognizing that systems built decades ago were designed for a different economic environment, a different workforce, and a different pace of technological change. The next generation of homeowners may not measure success by how long they hold a single property, but by how strategically they move within a dynamic housing landscape. The question is not whether the 30-year mortgage is good or bad. The question is whether it will remain the optimal tool in a rapidly shifting financial ecosystem. And the answer depends on how prepared you are to navigate what comes next. For a moment, imagine waking up in the year 2040 and realizing that the financial advice repeated for generations no longer applies in the same way it once did. The bank no longer offers a familiar 30-year fixed option as its primary product, but instead presents a menu of dynamic financing structures powered by artificial intelligence, income-based repayment models, and shared equity platforms that automatically adjust to economic conditions. At first glance, it feels innovative and empowering. Yet beneath that innovation lies uncertainty. Suspense builds not because change is inherently negative, but because change forces responsibility back into your hands. When the system becomes more flexible, it also becomes more complex. When underwriting becomes automated, it becomes less negotiable. The comfort of sitting across from a loan officer who evaluates your story could be replaced by an algorithm that evaluates your patterns. The implications of that shift are profound. Technology promises efficiency, but efficiency often removes a human buffer that once allowed exceptions and second chances. Stricter lending standards may not appear harsh on the surface, yet they could silently exclude buyers who do not fit clean financial models. Higher borrowing costs are already challenging affordability, and if interest rate volatility continues into the next decade, lenders may become even more cautious with long-term fixed commitments. A 30-year promise becomes riskier for institutions when economic cycles accelerate faster than expected. Instead of locking into one static rate for 3 decades, future loans may feature adjustable components tied to inflation metrics, employment trends, or even regional housing supply data. That possibility introduces both flexibility and vulnerability. Flexibility allows payments to decrease when conditions improve, but vulnerability exposes homeowners to rising costs during economic strain. The safety once associated with predictability begins to shift into a new form of calculated risk. Many people assume that innovation automatically creates simplicity, yet financial innovation often increases the number of variables you must understand. This is where awareness becomes your most powerful asset. If you rely solely on tradition, you risk being unprepared for a marketplace that no longer rewards passive decision-making. Another layer of suspense emerges when considering demographic and behavioral shifts. Younger generations have grown up during financial crises, rapid technological transformation, and shifting job markets. They value mobility, remote work flexibility, and diversified income streams. The idea of remaining tied to a single property for 30 years may feel restrictive compared to investing capital across multiple assets. Fractional ownership platforms already allow individuals to buy percentages of real estate rather than entire homes, reducing upfront costs while sharing appreciation potential. If these platforms mature and gain regulatory support, the concept of homeownership itself could be redefined. Instead of one household carrying one mortgage, groups of investors may collectively finance properties with digital contracts that execute automatically. That shift would not eliminate traditional ownership overnight, but it could erode its dominance gradually, almost invisibly. The most significant changes in finance rarely happen with dramatic announcements. They happen quietly, through incremental adoption that becomes normal before anyone realizes a transition is complete. Graham Stephan says that markets reward those who analyze trends before they become headlines. That insight becomes especially relevant in a housing landscape shaped by automation and innovation. Artificial intelligence does not only approve loans. It predicts default probabilities, identifies optimal repayment schedules, and structures financing that maximizes institutional profit margins while minimizing risk exposure. As these systems improve, lenders may reduce reliance on standardized products and instead offer hyper-personalized contracts. On the surface, personalization sounds beneficial, but also means fewer universally comparable options. If everyone receives a slightly different structure, benchmarking value becomes more complicated. Financial literacy must rise to meet that complexity. Without understanding how dynamic rates, shared equity clauses, or automated refinancing triggers work, borrowers could sign agreements that feel advantageous initially, but carry long-term implications they did not anticipate. There's also the possibility that stricter credit frameworks disproportionately impact individuals over 25 who carry student loan obligations or operate within gig-based income structures. Automation thrives on predictable data, yet modern careers are increasingly nonlinear. Income may fluctuate month to month. Contracts may replace salaries, and remote employment may cross state or even national boundaries. Traditional underwriting already struggles with these patterns. And while AI promises better adaptability, it also depends on clear data sets. If your financial profile appears inconsistent, an algorithm may classify you as higher risk regardless of your long-term potential. That classification could influence loan terms, down payment requirements, or even eligibility. The suspense here is subtle but significant. The future of housing finance may not close doors dramatically. It may simply narrow them quietly, rewarding those who structure their finances strategically, while leaving others confused about why approval feels harder than expected. Yet within this tension lies opportunity. Every structural shift creates new pathways for those who anticipate it. If dynamic mortgages become standard, understanding macroeconomic indicators becomes a personal advantage. If shared equity models rise, learning to negotiate ownership percentages and appreciation splits becomes a valuable skill. If automation dominates underwriting, optimizing your financial footprint through disciplined credit management, diversified income, and controlled liabilities becomes essential. The uncertainty of 2040 is not a prediction of collapse. It is a call for preparation. The end of the 30-year mortgage, if it happens, would not signal the end of homeownership. It would signal the beginning of a more sophisticated system where informed participants thrive. The suspense you feel when imagining this transition is not meant to create fear, but to awaken awareness, because the individuals who treat change as an invitation to study, adapt, and position themselves will not be surprised when the market evolves. They will already be ready. By the time 2040 arrives, the conversation will no longer be about whether the 30-year mortgage ended, but about who adapted early enough to benefit from whatever replaced it. Financial history has always rewarded anticipation over reaction. The people who thrive are rarely the ones who wait for certainty. They are the ones who prepare for multiple outcomes, while others debate whether change is even possible. If long-term fixed mortgages remain dominant, those who strengthen their credit, increase their liquidity, and position themselves wisely will still win. If dynamic financing models take over, those who studied economic indicators and understood flexible repayment systems will have the advantage. The key lesson is not about predicting a single outcome. It is about building resilience in an evolving system. Housing has never existed in isolation. It reflects interest rates, employment patterns, technological tools, demographic behavior, and government policy. When these variables shift together, transformation accelerates. The 30-year mortgage survived for decades because it aligned with stable wage growth, predictable inflation, and slower economic cycles. If those conditions permanently change, financial products must evolve to reflect new realities. Preparation begins with understanding leverage. A mortgage is not just a payment plan. It is a tool that magnifies both opportunity and risk. When borrowing costs are low and property values rise steadily, leverage builds wealth efficiently. When rates fluctuate sharply and appreciation slows, leverage becomes heavier. The future of housing finance may emphasize adaptive leverage rather than static leverage. That means shorter loan terms, adjustable equity participation, or hybrid contracts that rebalance risk between borrower and lender over time. Instead of asking whether a 30-year term is good or bad, a more powerful question emerges. Does this structure align with my income stability, risk tolerance, and long-term goals? This level of analysis requires discipline. It demands that you move beyond emotional attachment to tradition and step into strategic evaluation. Graham Stephan says that understanding your numbers is a foundation of smart investing, and that principle applies directly to housing decisions. If the financial landscape becomes more complex, Clarity about your own metrics becomes your competitive edge. Another crucial element of preparation is liquidity. In a world where financing options diversify, flexibility often favors those with accessible capital. Larger down payments, emergency reserves, and diversified investments provide negotiating power regardless of the dominant mortgage model. If stricter lending standards become common, strong liquidity offsets algorithmic skepticism. If fractional ownership grows, capital allows you to participate in multiple properties rather than concentrating risk in one. The individuals who treat savings as optional may find themselves limited in an automated underwriting environment. The individuals who treat liquidity as strategic freedom will move with confidence. This shift requires a mindset change. Instead of viewing homeownership as a final milestone of adulthood, it becomes one component of a broader financial architecture. Housing is not the destination. It is part of the strategy. Technological literacy also becomes essential. As artificial intelligence refines loan products and digital platforms tokenize property shares, understanding the mechanics behind these systems prevents blind participation. Algorithms are designed by institutions seeking profitability and efficiency. They are not inherently aligned with your personal goals. Reading contracts carefully, analyzing adjustment clauses, and evaluating long-term cost projections become non-negotiable habits. Automation may reduce paperwork, but it does not reduce responsibility. If anything, it increases the speed at which decisions carry consequences. By 2040, refinancing could happen automatically based on preset triggers. Equity stakes could rebalance digitally, and credit profiles could update in real time. Those who understand these processes will navigate them strategically. Those who ignore them may feel controlled by systems they never took the time to study. The deeper philosophical lesson within this transformation is about ownership itself. Ownership has always represented stability and control, yet the form of ownership evolves. Previous generations valued permanence because their economic environment rewarded staying in one place for decades. Future generations may prioritize adaptability because their opportunities shift more rapidly. Neither mindset is inherently superior. Each reflects its era. The danger lies in assuming that yesterday's solution automatically solves tomorrow's challenges. The 30-year mortgage may persist in some capacity, but its unquestioned dominance is no longer guaranteed. That realization should not create anxiety. It should create urgency to learn, urgency to analyze trends, urgency to strengthen financial fundamentals, urgency to become proactive rather than reactive. When you step back, the potential end of the traditional mortgage structure symbolizes something larger. It represents the broader truth that financial systems are living frameworks, constantly adjusting to technological progress and economic pressure. You cannot control macroeconomic cycles, but you can control preparation. You can build credit discipline. You can reduce unnecessary liabilities. You can diversify income streams. You can study market indicators. You can maintain liquidity. These actions position you for success regardless of which financing model dominates the next housing cycle. The individuals who wait for headlines to confirm change often act too late. The individuals who educate themselves early operate from strength rather than fear. As we move toward an uncertain but opportunity-filled 2040, remember that clarity outperforms comfort. Comfort keeps you attached to familiar structures. Clarity allows you to evaluate whether those structures still serve your goals. Whether the 30-year mortgage remains standard or evolves into something entirely new, your advantage lies in awareness, preparation, and decisive action. The future of housing finance will reward those who see change not as a threat to stability, but as a doorway to strategic growth. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.